Well, good afternoon, everyone. It's 2 o'clock, straight up. So today, a little bit about us. I am Elaine Shoemaker. I've been with the bank forever. Came into the wire transfer area and was promoted to safekeeping manager back in 1999. So that's a long time ago. Back in 2008, safekeeping and collateral operations were combined to create financial services, and I became manager of the area at that point in time. So anytime you're submitting your QCD form, pledging and releasing loans, pledging and releasing securities, that all comes through our area. And I would like to introduce, I'm so happy to welcome Deidre. She's our new Kylie. Kylie moved to a new position within the bank, so Deidre is now the Director of Collateral and Safekeeping Operations. And you have the review officers. Do you want to tell them a little bit about yourself, Deidre?
So, as Elaine said, I am new to the department. I have been with Federal Home Loan Bank about 13 years this year. I started off as a senior member credit risk analyst shortly after the financial crisis. And in 2017, I decided to make a little bit of change, went to the legal department, and helped build out the compliance department for the Federal Home Loan Bank. And then in 2022, about August, I was presented with this opportunity, decided to come back to credit and get into collateral. And as Elaine said, I work alongside her, and I also oversee the collateral review and verification process.
All right. So today, our goal is to provide a little bit of insight into the Federal Home Loan Bank's method of establishing collateral underwriting guidelines. We're going to talk about some of the important changes that have happened recently with our eligibility criteria, and hopefully we're just going to expand your overall knowledge of eligible collateral, what we consider to be eligible. So in order to accomplish these goals, our agenda is we're going to walk through why we have collateral guidelines. You know, we just don't make them up for fun. Recently approved changes by our board, actually just last week. We're going to go through the overview through the schedule of eligible collateral. Deidre is going to go into great detail about each asset category for us, and then we'll have a Q&A session at the end. And again, if you have questions along the way that are pertinent to what we're talking about, we'll try to answer those along the way. Okay? All right.
So for Federal Home Loan Bank, what is eligible collateral? I mean, obviously, we have a regulation that actually requires us to be, in the advance, to be secured by pledging and be a secured borrower. So assets pledged to the members for Federal Home Loan Bank credit obligations, and those must meet our eligibility underwriting guidelines. So within the member products and service guide, which I'll probably reference as NPSG throughout, there is a schedule of eligible collateral. And I'm going to say, you know, I'm new to this department, and there's a lot of different rules with the schedule of eligible collateral. It is my best friend. I actually have this printed off, and it's by me at my desk at all times so that I can answer any questions. So there is a lot to go over today, but that is kind of where it's derived ultimately from our regulators, and then we kind of tweak it from there and develop what you'll see in the NPSG.
Okay. So overall, the 50,000 view approach. We take cash, Federal Home Loan Bank CDs. For the cash, it has to be placed in your overnight account, and we will encumber those funds so they can't be moved as long as they're pledged. But you always have the ability to release those at any point in time as long as you have sufficient collateral remaining after the release. We take securities. They have to be safe kept with us in our safekeeping custodial services or at an approved third-party custodian. And in order to use a third-party custodian, it has to be pre-approved. There's agreements that have to be in place before you can start pledging. If you're interested in that, it's just a matter of the process starts out with an email to financial services and request the use of XYZ custodian. So after securities, we also take loans. You can, for all of our blanket pledge members that have strong financial conditions, we allow them to pledge their collateral via the QCD form. any of those institutions that become financially distressed a little bit,
Yeah.
we do have a delivery process and delivery requirements. So that's kind of a separate, we covered a lot of that yesterday during our reporting webinar. And the loans have to be owned by your institution. You can't pledge somebody else's collateral without all of the proper documentation in place. So just a high level, you know, we manage a lot of collateral today. Let me preface this. About 3 weeks ago, when I put this presentation together, this is where our collateral position stood. Total unpaid principal balance of approximately $159 billion. That's a B, with a lending value assigned to that of $118.9. Last year, when we did this presentation, we only had $96.6 billion in lending value. 3 weeks ago, we had 118.9. Today, we have 122 billion. It has changed that much in the last few weeks. So a breakdown then of loans versus securities. We have 103 billion in lending value for pledged loans. Almost all of that is pledged by our our blanket pledge members on the QCD form. And we have about 1,500 loans that are actually delivered to us and in our vault under delivery. Securities, we have 15.8 billion in lending value, which we track and manage over almost 6,200 securities that are pledged. All of this supports the total credit obligation of 50.8 billion. And again, that was about 3 weeks ago.
Yeah.
Last year, our total was 34.2 billion in our presentation. This was 3 weeks ago. Today, we're already at 54.2. So our world can change very quickly.
Okay.
So, Dieter, why do we have underwriting guidelines? Why?
Well, I mean, in general, it's just prudent risk management. I mean, just like at your member banks, you guys have your own risk policy, your tolerances, requirements that you have of your own borrowers. So it's very similar to what we do. We have our requirements, and furthermore, again, it goes back to it's also required by regulation. There's pieces of this that we have to have. So, you know, prudent risk management allows us to adequately manage risk, protect our stockholders. All of you guys are our stockholders together, so we want to make sure we're taking the best approach we can. We want to be able to be transparent on our guidelines and acceptable collateral. Like I said, there's a lot of information in there, but we want to be as transparent as we can to give you that information. Provide members with a streamlined approach to identify assets which can be pledged. It's generally, you can look at that guide and you can make a determination of what that is. There's some gray area ones that you can always reach out to us, but it just helps to have that there. And then homogeneous assets that are marketable and can be easily liquidated. And that's going to be a key thing. You'll see our regulator wants us to be able to prove that we can liquidate those assets in due course. So in order to accept assets as collateral, and this is per our regulation, we must be able to perfect the security interest in the asset. We have to be able to, obtain a readily ascertainable, value of assets. We have to be able to reliably discount the price, and we must be able to liquidate that in due course, like I stated. And, I think in all of our existences, we've never had to do that, but we have to recognize that we have to have the ability to do that.
Right. Our regulators require that.
Yes, they do.
Okay.
Okay. So how does Federal Home Loan Bank create underwriting guidelines? So under each asset class, we establish different criteria for those groups. Again, to make it similar characteristics like loans together. Makes it easier to manage. We consider other things. We look at the market trends and conditions, similar perfection process, similar liquidation process, any kind of volatility components. And again, any kind of troublesome loan characteristics. If there's spec loans, interest-only periods, anything that we see that are concerns in the industry, we'll look at all those things that could be lumped into those troublesome loan characteristics. High loan-to-values, debt service coverage ratios. And again, a lot of this is based off what our regulator will allow us to do, and then we tweak it from there. So, but those are the main factors we take into consideration.
Okay. So once we establish the eligibility criteria, we have to assign it lending values. And how we do that, it really consists of, for all of our blanket pledge members, consists really of three different factors. One is a credit factor. It's really, which is the asset quality of each collateral type by evaluating the historical performance of those asset types, as well as looking forward to the delinquency trends in our four-state area. The volatility factor. This really identifies the potential change in price during that period in time, which we would, from the time, so if a default was established, then we would have to liquidate the collateral. So from the time of the default to the time of liquidation, what's the change in volatility for that particular asset? For the blanket pledge members for the loans, it's a 90-day look back. CDFI institutions, it's a 1-year look back. Insurance companies that are domiciled in the state that has exemptions for Federal Home Loan Bank, those loans are 90 days look back. We also then have a liquidation factor, which is really, it's based on FDIC historical trends. It's really, what does it take, how much risk and the difficulty is there to liquidate that asset in due course, right? And what's cost associated with that. So we start out at 100, we minus the credit factor, we minus the volatility factor, minus the liquidation factor. And if you're a specific pledge member, there's also a model risk factor, which is really just trying to capture the potential market value price uncertainty for loans because we're using a third-party vendor, right? So your market value is based upon that price we get from the vendor. So just a little bit of uncertainty from their models. So
yeah. And then we also, I've already mentioned, we abide by our regulatory requirements and advisory bulletins. We also look at what your regulators are requiring, so, and concerns, again, that they may have. So, things such as delinquency, loan classifications, looking at a substandard, doubtful, anything like that. Non-traditional subprime and anti-predatory lending issues. Obviously, that was a big concern from the financial crisis. We went through that, so that's always high on the radar. We have numerous ABs or advisory bulletins that our regulators have issued that we have to incorporate that information. Again, appraisals, your guys' appraisal guidelines and regulatory requirements, loan to values, debt service coverage ratios, Rego, director, officer, and employee loans, and then PACE and private transfer fees. We look at that. We take those into account. PACE is something that has been heavily emphasized by our regulator. And in fact, the private transfer fees, we have an actual regulation that prohibits us from taking any collateral with that. So numerous things go into looking at what takes to go into the underwriting requirements of collateral.
So you as members saying, well, where am I going to find all of this information? Oh, there are so many different places you can find this. One is in the Member Products and Services Guide, available on our public website under Products, and then look for the Member Products Services Guide there. It also is, if you're logged into Members Only, under the Resources tab, and you go to the MPSG, or under the Collateral tab, when you go to the QCD form, there is a link to the schedule of eligible collateral there, as well as inside the QCD form. All of the hovers, when you're on a particular asset category, if you hover over that help function on the far right hand, it's a blue dot with a question mark in it. If you hover your mouse over there, it's going to populate or pop up on your screen all of the underwriting guidelines for that particular asset. So we have lumped assets into two different categories. One is an unrestricted category, versus restricted category. We're going to limit the amount of collateral on those restricted assets that you can pledge. So what falls under the unrestricted category is all of your securities, which, you know, our most commonplace pledge are treasuries, agency bonds, MBS CMOs, CMBS, PLMBS, and CMOs, and SBAs. We also accept Federal Home Loan Bank CDs and overnight deposits. We also take, in the unrestricted category, are the single-family loans, 1 to 4 conventionals with your interest only, and FHA VA, as well as your held-for-sale mortgages on 1 to 4 family. On the QCD form, you can pledge up to 15% of your held-for-sale loans. The QCD form will cap you at 15% of the assets that you entered at the top of the unrestricted page. If you want to go over at 15% of your assets, there is a daily reporting requirement, and we would get you set up. You just need to reach out and contact financial services, and we'll be happy to walk through that process for you. Also in the unrestricted is your multifamily real estate loans. In the restricted bucket, so first of all, we ask that you exhaust your unrestricted collateral first. And that doesn't mean you pledge every single loan that could possibly ever qualify. But, you know, for an example we had from yesterday's webinar, they're looking at, they review all of their loans that are $100,000 and above.
Yeah.
That's perfectly fine.
Yeah.
You know, we're not going to say, oh, well, you missed this $50,000 loan, right?
Yeah, and actually, Elaine, I mean, in talking to my staff, I mean, that would make sense in some categories. You know, maybe you don't want to pledge a lot of lower, you know, loans that could have issues with eligibility, and you do a collateral verification, and then your exceptions go above, and then you end up getting discounted. So I think some would like to stay above those levels, and yes, we're perfectly fine with that.
Right,
so.
right. So most institutions by default are restricted to these asset categories listed here to 25% of your asset total, unless you specifically request something different than that. That would require special approval. So the QCD form itself will restrict your assets, restricted asset cap, and it will tell you how much you can pledge based on the asset total that you entered on the unrestricted tab. In this category falls the commercial real estate, ag, second mortgages and HELOCs, construction loans. Residential, right now today, is the only construction loan category that's receiving lending value. Multifamily and commercial, because of the market today, the environment, we're still holding those at 0% lending value. Also, for our CFI institutions, the CFI collateral is considered to be restricted. It's the ag operating and equipment loans. A CFI institution is defined as an institution whose 3-year average assets is less than $1.417 billion. So every year that adjusts, it goes up every year.
Yeah.
So it just opens up a little bit more.
Yeah, and just to give you a little more background, yes, our regulator actually determines that limit every year, and they'll send us out and give us a regulatory update, and at that time we will adjust that limit, and we'll go from there.
Yeah. So last week, as I mentioned, our board of directors approved lending value changes. We went through our lending value methodology, which we do every year, and because of the volatile pricing for these 1 to 4 family loans, we took a big hit to this category. The conventional 1 to 4 family are dropping from 81% to 77%. The interest-only 1 to 4s are going from 75 to 72%. FHA and VA, less than 90 days delinquent is 92, going down to 87. Greater than 90 days delinquent, from 88 down to 83%. Our held for sale 1 to 4 family. Eligible to be sold to Freddie, Fannie, Jenny is 92 going down to 87. And not eligible to be sold is going, or to Freddie, Fannie, Jenny, going from 81 down to 77. So securities. The most commonly pledged are the agency residential mortgage pass-through securities. Those are going to go from 98 down to 94. CMOs typically will go from 97 to 96, and the agency structured bonds are from 96 down to 89. There are multiple other lending value changes in the securities realm, but yeah, we'd be here way too long.
Yeah.
So the timing of these changes, very important. The securities and the delivered loans, those that will actually have the notes in our vault, those lending values will change on Monday, April 3rd. For all of those who are pledging via the QCD form, you will not see your lending value changes until you submit your 6/30 QCD form. So you get to ride this little bit higher lending value for a little bit longer, for about another 3 months or so. So, all right. Other lending value changes. Your ag gone from 66 up to 72%. Your commercial real estate is just unchanged at 65. Seconds on 1 to 4 family and your HELOCs. Both are going from 71 down to 66. And the construction, residential construction loans are going from 66 down to 63%. We have seen, because of the ag improvement, operating loans are going from 57 up to 63. And equipment loans are 54 going up to 58. So a little bit of an offset. I know the bulk of our collateral is those single family loans, the 1 to 4. So it's the environment that we live in today.
Yeah.
All right. Just, as a summary on the impact of our lending value changes. And again, this was as of the 6th of February. Looks like our net collateral change is down $3 billion. So unfortunately, it hits hard. Like I said, the bulk of that is in our 1 to 4 family loans.
But really, after looking, just comparing it to last year, we kind of went up about 3% last year, so we're kind of just offsetting what happened last year.
Right.
And honestly, I don't think it's too bad after the year that we had with the rising interest rate environment.
So just to put it all back into perspective for you, we put this little chart together about the trends in our lending values over the last, 6 years. So hopefully, as you can see, we went from 79 up to 80, down to 78, up to 79, up to 81. Now we're back down to 77. So hopefully next year we'll tick back up.
Yeah,
so.
Relatively stable. Yes, some ups and downs, but nothing too drastic, it doesn't look like. So that's good.
All right. So other notable changes that were approved by our board of directors is LIBOR index loans. Okay. So no adjustable rate IBOR, which includes LIBOR loans, with a note date after December 31st, 2021, or those that have the LIBOR tenors of 1 week, 2 months, or any remaining tenors after the June 30th, 2023, because LIBOR, that's the LIBOR cessation. Thank you, Kate. I couldn't get that out.
It's okay.
Our expectation, because today we asked you to break out your LIBOR linked loans on the QCD form. With the LIBOR Act that was instituted by Congress last year, and the definitions of the effective fallback language is below on the screen for your reference. But our expectation is that LIBOR Act, if there wasn't sufficient fallback language, everything then defaults to SOFR.
Yeah.
basically.
Mm-hmm.
So 630, you'll still have to break out your LIBOR-linked loans on your QCD form. Anything after that, if for whatever reason it doesn't convert because of the LIBOR Act, it's not eligible,
Mm-hmm.
or it's no longer tied to LIBOR, so there shouldn't be anything more to report
Yes.
on that LIBOR.
That's right.
Okay. Also, some exciting news. We did a whole fee evaluation across the bank, and collateral fees, the only thing that is going to change is for those specific pledge institutions
Mm-hmm.
who we send the collateral out to be priced. Our loan pricing is going from $40 per loan down to, if it's a multifamily commercial real estate loan, it's going down to $13.50. And if it's a single-family loan, it's going to drop down to $3. Huge drop. So we're kind of excited about that. We're going to take a win wherever we can get
Mm-hmm.
it. All right, securities. Brief, high level, no interest only or principal only securities, where the cash flows are derived from underlying collateral. Sorry, where the underlying collateral is no principal or interest. Okay, sorry, Fred said that incorrectly. Prices, we have to be able to price through our normal pricing vendors. Sometimes the prospectus will be required if it's a private issue, CMO. We can't get the information we need on it, or some municipal bonds that are case by case. We'll need a prospectus on that. The underlying loan collateral can't violate the anti-predatory lending policies for the Federal Home Bank. We do have a ratings requirement on our CMBS and our private issue CMOs and MBS. It has to be AA or AAA from S&P, Moody's, or Fitch. And no private issue, residential mortgage pass-throughs, and CMOs. The underlying loan collateral cannot be secured by property subject to private transfer fee covenants that were created on or after February 8, 2011. It must comply with the interagency guidance on non-traditional mortgage products risks and the addendum to credit risk management guidance for home equity lending if it was issued or acquired after July 10th of 2007. That's our magic date. All credit ratings must be AA or better.
Okay. Now we're going to get into some of the underwriting guidelines for loans, which, as I told you at the start of this, the schedule of eligible collateral and the NPSG is a lifesaver. So if you are not familiar with it, I would suggest all of you print it out and have it by your side at all times. But here we'll start with some of the commonalities between asset categories. And I'm not going to go through every single one of these, but I will kind of call out a few of them. So within that, wet signature. All of our pledge collateral, those promissory notes must be a wet signature. We'll get to a little bit about e-signatures, but right at this point in time, we require a wet signature on promissory note. They must be fully secured. Loan to values, they must be within the guidelines that we have established, and you must base that off of your applicable regulation that you're required to comply with. Located in the United States, wholly owned. I think Elaine mentioned that, and we'll cover a little bit more here in a little bit. PACE liens, no PACE liens. They may not have any private transfer fees, no Rego Loans, and nothing that's past due, 60 days for single family, or 90 for single family, 60 for other asset classes, and no classified assets. So no, you can't pledge any substandard, doubtful loss, non-accrual type loans. As Elaine just mentioned, no LIBOR index loans. And so all these you'll see throughout the guidelines, very common between all the asset categories.
Okay, wet signatures. That is still a very hot topic.
It is a very hot topic, and I'll be honest. I mean, I've been in this role for 7 months, and I've got this question often, and it does seem a little odd, I think, in the day and age of electronic and what we went through with the pandemic. But at the fact stands at this moment, it's still a wet signature. Unfortunately, I think the big hang-up is that the UCC laws haven't caught up with technology. Right. That's my understanding. So once that legal framework is developed and established, going forward, I think we'll have a different opinion. But at this moment, it's wet signature on those promissory notes.
Or it's an e-note.
Oh, yeah, or an e-note. Yes,
right.
Exactly,
so,
as it says in here. So
what is an e-note? Is it a scanned document?
it is not a scanned document. An e-note is a little more complicated than that. So as you'll see, this has electronic signatures versus scanned versus e-notes. An e-note, it has to be executed electronically. It has to be stored in an electronic vault, an e-vault that we would have. And it must meet all the requirements for an e-note, which out on our website, which you'll see a link down at the bottom, there is a listing of all the requirements that you must meet to be an official e-note. What an e-note is not, it is not a scanned image of a wet ink signature. It's not an electronic signature like with DocuSign or anything of that nature. It's not stored in an e-vault, and it doesn't meet the e-note requirements. So,
and we do. I mean, we have some e-notes pledged to us today that we hold in our
Yeah.
e-vault. So.
Yeah, I was just going to say that. So we actually have had a few members that have reached out, and as Elaine alluded to, we do have some that are already pledging e-notes. So it is a possibility. My understanding from the member side, it takes a lot of work and effort, but we are there at that point to take that. So just remember right now, wet signature is what we need on promissory notes, unless it is an e-note.
Right.
So
only single family at this time.
yeah, a single family. Sorry, yes.
All right.
Okay.
What does fully secured mean?
Well, it's kind of what it means. It's just you need to be fully secured, have the balance covered with whatever collateral that you're pledging. So a loan in which the fair market value of the asset or asset pledged as a security for the loan exceeds the outstanding principal of the loan. So for the different categories, loan to value, you'll see single families at 100%, multifamily, commercial, agricultural at 85%. And again, must comply with your appraisal, your regulatory requirements, whether that's OCC, FDIC, whatever that regulation entails, you must comply with that. And one thing I would like to note, there's mortgage amount must equal or exceed outstanding principal amount. We have a future advanced deed of trust in Nebraska. So it's my understanding Nebraska has a special law that we do it a little bit differently. And a future advance that has no limit is called an unlimited advance deed of trust. They are allowed to be pledged to us. The only caveat of that is if you go to advance more funds on that note, you would have to do an additional title search to make sure no one snuck in there in between the advancement of the other. But that is a little bit different. And again, my understanding, it's Nebraska law, and that's the only state in our territory that we will accept those. Okay. As far as located in the United States, pretty simple, all collateral, real estate, whether it's equipment. I've had those questions, I have some tractors, I have this. All that needs to be located here within the United States.
Perfect. Okay.
Okay.
How about some term limitations?
Term limitations. Okay, so unless specifically stated, there are some differences amongst the asset categories. They are limited to 360 months. So that is what we look at for the term. Wholly owned, again, this can be, I don't think it's that confusing, but for some it is. If you originated that loan at your institution, you own 100% of that, and you can pledge that. If it's originated by another institution and you purchase or acquire 100% of that loan, you can also pledge that. It is yours at that time. It's wholly owned. If it's originated by your institution and you own less than 100%, maybe you sold a portion off, you can pledge that net portion of that loan to us.
The portion that you retain,
yeah,
right?
The portion that you retain.
Okay.
And if it's originated by another institution, you purchase, acquired, and it's less than the 100%, we do have a special agreements in place that we can discuss with us, but it does take special approval. So it would be reaching out to me and we can work through that process. So we do have some members that have those types of collateral.
Hey, Deidre, we've got a question that popped in about wet signatures.
Yes.
Do modifications also have to have a wet signature?
Modifications, actually, that changed last year, I think March of last year, where you can have, again, there's requirements in the NPSG, but modifications can be e-signature as long as you have the original promissory note that is wet ink signed. So,
Thank you. All right, moving on. How about no lease loans?
Any finance transaction is a form of lease structured, financing. We don't allow no lease loans. Pretty simple on that. and no land development, vacant land. We have on there ag, real estate. It's fine if it's actively worked. So if you're producing something on it, that's fine. That doesn't count. But there's no lots, no subdivisions, that's getting ready to be, gutter, sewer, things of that nature, getting ready for development. That's not going to be allowed in our underwriting guidelines.
Okay.
I'm kind of hit on this already, but again, I'll just go into a little bit more information. The PACE loans, we don't allow anything that has a PACE loan. And really this came about in about 2010 by our regulator, became a hot topic. It is energy efficient improvement programs that you might find at state and local municipalities. And it's tied to your taxes on those loans. So we, in that position, get bumped. That takes a first lien priority. So our regulator really doesn't like us taking collateral where we're not first lien positioned.
Right.
So, it makes sense. So no PACE loans at this time. And as I mentioned on the private transfer fees, that actually is a regulation for us. And what a private transfer fee is, essentially a fee that is imposed by a covenant that is required to be paid anytime there's a transfer between a title of real estate. So if a builder has a piece of land, builds a house, sells that land to Susie, Susie goes to turn it over to Elaine, and there's going to be this private transfer fee that builder is going to get for the life of their existence. And some of them have limited terms, but some of it can be indefinitely that they get these private transfer fees. And you can find that information in the title work and the settlement statement. So again, we don't see PACE loan and private transfer fees very often, but again, we do not accept those in our collateral. Again, common things, no Rego. We don't allow those kinds of loans to be pledged, or even for Federal Home Loan Bank employees. Right. I think there's been instances where that's occurred, and if we find it, we're not going to allow you to pledge that to us. So,
yeah, you might have Deidre's loan might be one of the best loans you got, but unfortunately, you can't pledge that to us as collateral.
Exactly. No loans past due. Obviously, there are already some weaknesses there, right? So, but we have that cap. Single family, it's 90 days. All other assets, 60 days. So no past due, no classified assets. So again, those loans that are in distress, trouble, substandard, doubtful, we don't want those as collateral. We want to be able to be able to liquidate if we need to, clean and ready to go. They can be on your watch list, your internal watch list. But, if it jumps from watch list to substandard doubtful, then at that point it becomes ineligible. Okay. Not pledged to another creditor or in another asset category. So
I can't pledge it in two different categories?
No, we can't do any double dipping.
I can't pledge it to Federal Home Loan Bank and the Fed?
No, that's a good example. And right now there's a lot of that going on with some of the stuff that's happening. But no, you cannot pledge a loan to both categories or to both entities. And then you can't actually split, like say you have a CRE loan with equipment put in there. You can't split between the loan categories. You got to pick one or the other. That would be lesser of the value. Right. So there's no splitting of the assets. And as Elaine already mentioned, I'm not going to read all that. We're not going to accept the LIBOR index loan. So that as of 6/30, as Elaine explained, later on in the year, we shouldn't even be seeing anything reported on the QCD. So no, nothing there. And then as far as servicing or custodial agreements must be on file for third-party servicers and third-party custodians. Want to just make sure that we have those agreements on file and that we can confirm that information.
Okay. All right, so those are all the general guidelines across all of the multiple asset types. So how about let's get started into some of the specific ones for the 1 to 4 family.
Yeah, so we're going to get into the nitty-gritty, and some of it's going to be pretty in-depth, so hang it with me there. So first lien on 1 to 4 family, it's going to be first lien position. Second lien, if it's a second lien, it needs to go in the second mortgage category. It must be fully dispersed. No revolving lines of credit go into the 1 to 4 family conventional. Must not have any subprime characteristics. Again, as we know from the financial, crisis back in the day, many borrowers had subprime. The higher default risk, typically weakened credit histories. So we don't need it. We don't want to see that. Unfortunately, in any of the guidance or regulations out there, it's not really defined what the prime is. So we've taken the approach of this 2-tiered test. So If it's FICO less than 660 and a combined debt to income greater than 50%, not eligible. If it's a FICO less than 620 or a debt to income greater than 55% without compensating factors, it's not eligible. So if you had a loan, let's say at, I don't know, 600, and you had compensating factors, maybe their debt to income is amazing, maybe you have a loan to value of like 30%. So you might have some compensating factors. We're going to ask, why did you make this deal? So that's what we're going to look for there. And then again, non-traditional characteristics. Again, a lot of that comes from the financial crisis. Going to look for the income employment verification, any kind of seconds, that are at the same time as the first, arms. If you have a adjustable real estate mortgage and that borrower, you starts out at a low rate, can they support that when that rate goes up to a higher, when it adjusts, So we need to make sure they go beyond just the teaser rate there. Okay, 1 to 4 family conventional, again, carried on. No predatory characteristics, no mandatory arbitration, high fee rates, HOPA, prepayment penalties, and this is more prepayment penalties past 3 to 5 years. Like This is out further down the road. Single premium credit life disability, no reverse mortgages, and no one-time, closed construction to permit, or one-time.
Yeah, we allow the one-time closed construction. Yeah.
And the term begins with the conversion to permanent financing.
Oh, okay. Good to know. So are interest-only loans, what's the difference there?
Is the score. The minimum FICO score has to be at least 680.
Okay.
Main difference there.
All right. Moving on to our FHA-VA loans.
Yeah, FHA-VA loans, they must comply with the agency's underwriting guidelines. Certificate of guarantee present. They can be 90 days past due, the lending value based on the guaranteed portion. There is a special entry, I think, that we have on the QCD form that specifically you make a little.
Only for the FHA and the VA greater than 90 days, there's a guaranteed portion line that you have to enter that amount on.
Yeah. And held for sale loans, agency eligible, so Fannie, Freddie, and Ginnie. Non-agency eligible, QCD forms versus daily reporting.
Right, so the QCD form up to 15% of your assets, and the daily reporting if you want to go over that 15%. Okay, on multifamily.
Multifamily, I'm trying to cruise here. We only have about 15 minutes left, so 5 or more units. And I think this can be a little confusing for some individuals. It's actually, it's the structure must have 5 units or more itself. So like, if you have collateral pledge and it's 4 duplexes, that's not multifamily. Those duplexes themselves are still just the 2 units. We're looking at those structures that have 5 or more in total. So just be aware of that.
So like a big apartment complex.
Yeah, something of that nature would be what we're talking about. But again, if you ever have questions, just reach out. Interest only, 7 years or less. Maximum loan to value here has got to be 85%. Debt service coverage ratio has got to be over 1%. And as I've mentioned previously, appraisals should always comply with your applicable regulation.
All right, so now we're moving into the restricted asset category.
Yep, restricted category. So with the commercial real estate, again, interest only 7 years or less. Maximum loan to value for blanket pledge members is 85%. Debt service coverage is greater than or equal to 1%. Phase 1 requirements, and with that, that's usually with collateral with any kind of adverse environmental factors. Anything like a gas station, a Jiffy Lube, things of that nature, very common. C-stores, that's what comes to mind for phase 1. If you have a gas station, if you have a clean bill of health there, or the tanks and the storage underground all contained.
So just to qualify that just a little bit, it has to be a clean phase 1.
Has to be a clean phase 1.
You may have one, but it may not be clean, and then you can't pledge it.
That is true.
Okay.
Again, no vacant land or land development, must be secured by CRE property, no leasehold estate. And it cannot be secured by property used by marijuana-related business. And this is across the board. We recognize and we understand that we are in a territory that we do have states that it's legalized in those states. However, it is still not,
Federally.
yes, it's not going to pass the mustard with it. So in all categories, that is a no-no for that. Again, appraisals must comply with applicable regulations.
Okay, ag.
Ag real estate. Maximum loan to value 85%. Interest only limited to 18 months. No vacant land. Unless you're using it for agricultural purposes, like I said before, it has to be actively being worked. No leasehold estates, cannot, already covered, the marijuana-related business is not going to be allowed, and no loans with a guarantee from USD FSA Guaranteed Farm Loan Program. It's my understanding, working with the FSA, that if we did have to liquidate, it can be a very messy process, and our position is we really just don't want to be involved, and we can't be in that.
I don't think we can't be involved.
Yeah, so.
All right, second mortgages.
Okay, second mortgages. Again, this category is really going to align with a lot with the 1 to 4 conventional, a lot of the same things. Obviously, there's a second lien position. 1 to 4 family properties only, fully dispersed. Again, none of the no subprime, non-traditional predatory characteristics, no negative amortization, and maximum combined loan to value of 100%. So we would take the first and the second to calculate what that loan to value would be against that appraisal.
And can't go over 100.
Can't go over.
All right. Home equity line, or HELOC.
Yes, again, very similar to the second, but on this case, we can take a first or second lien position with the HELOC. 1 to 4 family properties again. Revolving lines of credit, so a little bit different there. Again, no subprime, non-traditional predatory, no negative amortization, and maximum combined loan to value of 100%. And even if this is not fully advanced, we're going to look at the full line to calculate that combined loan to value.
Okay.
So just be aware of that when we're looking at that.
Oh, residential.
Okay.
Construction loans. Your favorite.
Yeah, residential construction. So no spec loan. If it's got a contract for sale or for rent, that's fine, but nothing from a builder, no spec. No subprime, non-traditional predatory characteristics. Again, no negative amortization. Interest only or principal payments required. One-time closed construction or permanent financing loans allowed. Initial advance must a period of 12 months, may not exceed the 18 months. And again, this loan to value will be based on the proposed value of the appraisal up to 100%.
All right, you're speeding right through this. This is
We're trying. We have 10 minutes left, so we don't want it to go over like yesterday. So, and we have several questions coming in, and we will try to get to all of those here in just a minute.
Yep, absolutely.
Okay.
All right, ag.
Okay, ag operating. Secured by crops and or livestock in a combination with ag real estate. This is, I should back up, this is for the CFI institutions only.
No, not operating, I'm sorry. I'm wrong. I'm on ag real estate,
okay.
not operating.
I was like, Elaine explained what a CFI was earlier, but this is for CFI.
Elaine should pay attention better.
That's okay. If interest only, limited to an 18-month term. Again, revolving line of credit's allowed here. No carryover debt. So if that ag operating line, the crops from last year didn't get paid, didn't get taken care of, not going to carry that over into this year and with this line. So not allowed. Cannot be secured by property crops used for marijuana. We already talked about that. And again, no loans with the USD FSA Guaranteed Farm Loan Program. So.
Okay. Right, and some more CFI collateral.
Yes, equipment. This is also for CFI. If you are designated as a CFI, I had mentioned previously, that, for business or farm equipment, it must be located in the U.S. Anywhere, that's fine. No interest only on or negative amortizing loans. Fully dispersed. Again, no carryover debt. Must be or cannot be, securing any property or equipment used for marijuana-related business. And again, no loans with guarantee from USD FSA Guaranteed Farm Loan Program.
All right. All right. Just a quick recap.
I know. So we've gone through a lot of information, and again, this category is you'll see as you go through the MPSG, some of these terms are specific to certain asset categories. I mean, you have to pay close attention because there are some differences, some that are the same. But, you know, as we mentioned on some of these interest-only terms, some are allowed for interest-only, some do not. So got to pay attention. Subprime predatory non-traditional characteristics, we don't want any of that. Leaseholds, again, could be something that differentiates between the different categories. Appraisal requirements, going to go back to following and complying with your applicable regulatory requirements. Loan-to-value requirements, again, different for different asset categories. As I mentioned earlier, for phase one, it's going to be in commercial real estate. It's not going to be required in all loan types, so just be aware. Revolving lines of credit, again, some categories we've accepted it, and then you'll see that in others it's not, can't do it. Yep. In all cases, as I've mentioned, I feel like I'm beating a dead horse here, we cannot accept marijuana-related property, crops, or equipment. So just know that. And loans with a guarantee from the USD FSA program.
Unfortunately, right? All right. So what happens, Deidre, if, you know, we have a very well-defined sandbox we have to play within.
Mm-hmm.
But what happens if I have a loan that qualifies, or a group of loans that qualifies all of the other, under the other eligibility guidelines, except maybe one? Maybe my term is more than 360 months.
Mm-hmm.
Can I apply for special approval?
There have been certain situations we can sit down and work with the borrower and discuss and look at what that, you know, what all the information is. Mm-hmm. So again, in my time, I have actually sat down with a few member institutions, and we've looked at those pieces of collateral that, you know, and they're like, hey, you know, we're not really sure we can pledge these. There's some unique characteristics. We recognize that not all assets are created the same. So we want to sit down and let's take a look at that. You know, we want you to exhaust all the other eligible collateral first, but there have been situations where the members have done that, and they've brought to us certain types of collaterals that you get, you know, again, they may have a portfolio of a certain type that have all common characteristics, just like we've gone through. And we've determined that, you know, I think on the whole that this is I think we can do this. We can do this on a case-by-case deal. So if we do that route, it does require written request from the member asking for a case-by-case, first of all. Mm-hmm. Again, we'll look at that, look at the dollar, get some more information from you, maybe even have a conversation and just get you on the phone and get those details, because that's a little bit easier, it seems to be. And then we would go through and make that determination, and if we accept it or not. And if we accept that case by case, you know, there are some other additional haircuts, lending value. But yeah,
all of that will be conveyed.
Yes. And so I would say if you do have any categories like that, please reach out to us. I mean, we can always sit down and discuss it. I mean, some it may be okay, and some we might say, no, we can't, it's not going to work.
And so the case by case fee. So if you have any requests, feel free to bring them to our attention. If we feel like that it's maybe something that we can accommodate, but would have to dig deep into that and go through that process, for the loan categories, there's a $500 minimum $500 case-by-case review fee. But if in our early discussions it's like, well, no, that's pretty clear cut that we're not going to be able to accept that, we're not going to charge you that case-by-case fee. On securities, kind of falls out the same with the municipal bonds. The municipal bond review fee, case-by-case review fee, is $125 per CUSIP. Okay, so those are just the additional fees that could be imposed. All right, so we've hit the Q&A section. Deidre, looks like we've got
we have some questions, and I'm going to apologize because I'm going to guess within 5 minutes we're probably not going to get to all these questions. So, but what I can do on several of these questions, and I'll be honest, I don't know all these answers right off the top of my head because, again, being fairly new in this position, I may not be able to give you those exact details. So I will get in contact with you, or after the webinar, my information is available if you want to email me, directly, but I'll try to capture these questions and get it prepared for you. So Let's go through and see what we can.
An e-note is acceptable for what type of loans that they can pledge. Those are only the single family loans, right? Unfortunately, not today. No commercial, no multifamily, none of those. So just the single-family loans.
Yes.
All right.
Okay.
Now, we don't use DocuSign for electronic signatures on any of our real estate loans, but have used it some for our farm operating loans and equipment loans. So if I understand correctly, we cannot pledge any of those operating or equipment loans that have an electronic signature. That is correct. It has to be a wet signature.
Yes, and again, I realize that seems a little confusing with our day and age, but it has to be wet ink signature on that. Okay.
All right. How about our subprime characteristics test based on origination information only?
Yes, it is based off origination only. However, with the caveat that if I have collateral review officers out at your bank and say they have updated information, I think they will go use the most current information for that.
If it's available.
If it's available. But otherwise, it goes to the origination date.
All right. Does the DSCR for ag real estate have to be above 1?
No.
No.
That's just for commercial.
Just for commercial?
Yeah.
Okay.
Yeah.
Okay, we're going to back up to commercial real estate. Did you state all commercial real estate loans must have a phase 1 in the file or to be eligible?
No, I think it would really be dependent on what it is. You know, my collateral verification, when they go out and perform that, it's going to probably be digging into that file. I mean, if they get in there and it's like a gas station and you don't have a phase 1, then they're going to be like, you need a phase 1. So it's going to be more...
Or Jiffy Lube.
Or Jiffy Lube or anything.
Dry cleaner.
Dry cleaner.
Those types of things. So they have to dispose of toxic byproducts or toxic chemicals that something they're going to have to dispose of properly.
Anything that can have an environmental impact.
There you go.
That's where we would be looking at. So not required on all, but in those cases, if my collateral review officers get out there and find something, they are going to expect to see a phase 1 in the file.
A clean phase 1.
Yes, a clean is the key word. Yes, thank you, Elaine.
Ag operating loans. Can the collateral be ag real estate only with evidence of first lien and of 100% of value or greater secured? Ag operating loans. Can the collateral be ag real estate only? No, there's an ag real estate category.
Yeah, you would put that in the ag real estate category.
Right. On ag operating and equipment loans, what is the loan to value? Oh, we're looking real quick. We're going to make sure we say that right.
Loan to values on that. Monica, if you would, can you email Deidre after the webinar and I'll look at that? I do not recall and remember everything. As I stated, I usually have my schedule of eligible collateral right beside me, so if you would email me, that would be great.
Oh, I have it. We'll go on and we'll come back. I have mine by me.
Okay. Please clarify in carryover debt. If a loan is carryover debt, must all loans for that borrower be excluded? If the carryover amount is transferred to a fully secured real estate loan, is it immediately eligible? Thank you. Margaret, I know I have your email, and I'm going to get with my staff to see how they've been looking at that going forward. So I'll get back to you right after the webinar when I ask that question, okay? And do we have any other questions? I hope, and I think we got a majority. Oh, we have one in the chat. Okay.
Well, I do not see. There is not a loan to value.
Okay, thanks, Monica.
All right.
Okay, so I think we've got everything. Okay.
So accurate reporting is critical, right?
Mm-hmm.
It determines the borrowing capacity at the Federal Home Loan Bank. You maximize liquidity by allowing non-liquid assets to be used as collateral. It improves the results during a collateral verification. So tomorrow is our collateral verification webinar. So the criteria of how you might be selected, we'll go through all of that tomorrow. But if it's an eligible loan, it goes a whole lot faster through that review process versus trying to qualify an ineligible loan. So it also reduces the expenses associated with collateral verification. So we continued with the no fees up to how many hours?
20.
Up to 20 hours. So you want to have all of your reports ready, go through the loans, because we're going to send you the list of loans that we're going to come out and look at. So to keep under those 20 hours that collateral review officer is going to spend on site, if you have all of this stuff put together and it's all accurate and in one place, that review is going to go very quickly, and then easier. There are no expenses associated with that. So accurate reporting is key. So we do have some upcoming educational opportunities. First of all, which is our annual management conference just in a few weeks in April. Down in, over in Kansas City, Overland Park. It's an excellent opportunity. We've had great reviews over that conference, so highly recommend that. We also have regional meetings in our 4-state area later on this fall. More information will be coming out as those get closer. And you always have the opportunity to contact one of our collateral review staff for eligibility questions. If you have any questions, we're here to help you. We're here to make you successful.
Yeah, and to be honest, like I said, I'm new to this role, and if you ask me questions, it helps me to dig in and learn more. So please reach out, and we can always get you an answer to what you need.
Absolutely. We don't know the answer, we'll find somebody who does. And again, here is our contact information. Please feel free to reach out. Yeah. Again, this is what we live for. This is our job. We enjoy what we get to do. So help us, help you. Yeah. Feel free to give us a call. So if we have any other questions come through, we'll take note of those and try to correspond directly with you. But gosh, we really appreciate you all taking your time out of your busy schedules to be with us today. Hopefully you'll be able to attend tomorrow's collateral verification webinar. Same time, same BAT station, 2 o'clock tomorrow afternoon. Yep. Right. Again, thank you all very much. We appreciate you being with us today.
Thank you.